Following years of healthy growth, the European economy is experiencing a slowdown that began in the second half of 2018. Markets are adjusting, but liquidity remains high, and interest in income-producing investments is robust. Adjusted for inflation, house prices rose almost 3% across Europe in the year to the second quarter of 2019. This is a slowdown of 100 BP compared to 2018, but a development that prolongs the expansion of the European house price cycle into its sixth year. This dynamic is also reflected in the constant growth of institutional residential investment volumes from 5 billion euros in 2009 to 50.8 billion euros in 2018, amounting to almost 1 billion euros per week. Many cities are struggling with the challenges posed by booming urbanization and the resulting soaring rental prices. Some governments are responding by setting limits on the rent that property owners can charge. But this will have long-term negative consequences. Rent control only benefits current renters and can cause rental stock to be transferred into the owner-occupier market. Rent control can also harm surrounding communities, as the restricted supply of available units forces potential renters to spill into these areas seeking accommodation, which causes rents to rise there. Plus, property owners have little incentive to maintain or improve properties. One of the most vivid examples of the impact of rent control was seen in East Germany at the time of the reunification. 40 years of centralized rent control left the housing stock in deplorable conditions. Today, investors developing a European residential investment strategy are often frustrated by a lack of rental data. Despite efforts in data harmonization, a European database on residential rents still does not exist. At PATRIZIA, we have been collecting rental data since 2000 to construct a time series of rents at city level. The resulting European database is unique and covers 72 cities across 13 countries. This provides important insights into the European rental cycle. First, rental growth has remained in positive territory, and second, the rental cycle shows low volatility since the GFC. Both aspects underpin the stabilization aspect of residential investments. Looking at the compound annual growth rate on a city level over the past 5 years, 85% of the cities have seen positive rental growth. The highest can be found in the PIGS, Portugal, Ireland and Spain, where cities like Barcelona, Cork, Dublin and Madrid show catch-up effects and a maturing of the private rental sector. The PATRIZIA database on market rents will continue to grow to accompany investment strategies, serving as a guide for our clients to rental growth assumptions and market correlations. Compared to 2018, fundamentals for investing in European multifamily housing are still solid. Investors need to pay close attention to the income stream delivered by each asset, as well as remain sensitive to regulatory political changes. Taking this into account, investors can expect total unlevered returns for buy-and-hold multifamily housing strategies between 5% and 6.5% per annum over the next 5 years, of which 2.5 to 3.5% will be income return. Want to get the bigger residential picture across Europe? Download the full PATRIZIA Insight Report on European residential markets 2019 to 2020.